Welcome to the video. Today we're going to be covering accrued income. We are going to be covering a definition, and we're also going to be covering how we use it. And we're going to include an example. I released a video on deferred income at 6 o'clock in the evening last Monday, the 12th of October. And this will go hand in hand with that, as it is essentially the opposite. Accrued income is income that has been earned but not yet invoiced. So let's run through the definition. Income that has been earned basically relates to the provision of services that you have provided. This is simple enough, but the tricky part is the next part of the definition. If we were to invoice for services as we performed them, the double entry for this would be debit accounts receivable and credit revenue. This should be familiar to you if you've watched the debits and credits video that I published for this playlist. I'll link it in the top corner and in the description. However, as we haven't invoiced for this yet, we can't debit accounts receivable, and this is where our accrued income comes in. Not yet invoiced is the key part of this definition, as it means that we can't just debit accounts receivable, as this ledger is where our invoices sit that haven't been paid. As we haven't actually raised the invoice, we can't debit this account. Instead, we debit our accrued income. This is also an asset like accounts receivable, but just keeps it separate from there as it's not yet invoiced. Now, there will come a point where we do invoice for this service. Raising the invoice is simple enough. You credit your revenue and you debit your accounts receivable, but you remember that we already credited income when we put our adjustment in for the accrued income. So we simply reverse our accrued income journal in the period we raised the invoice. So the net effect in the P&L is nil, and the accrued income ledger is reduced to zero. Now that was quite a lot of information to just take in by me just saying it and not actually showing you anything. So we're now going to run through an example. If you watch the accruals and prepayments video, you'll recognise this example, but instead of recording their costs in their books for our accountancy services, I'm going to talk about what we would be putting in our books for our services we haven't invoiced for yet. We are doing the January management accounts for XYZ Limited. We are completing this work in February to ensure all January transactions are included. But as we are providing accountancy services relating to January management accounts, we need to recognise the income for our accountancy services in our January profit and loss. However, we'll have to invoice in February, as this is when we'll be doing our work. So we need to post accrued income for this. The first thing we want to do is set up our page so that we know what we're dealing with. If we just jot down the key information we need to know. So for the purposes of this, we'll say that our fees are for £1,000. So we want to include £1,000 here. We know that we're going to be dealing with January and February. So we accrue in January, accrued income. And then in Feb, we want to reverse the accrued income and we raise the invoice. So now let's set up our page for the January and February ledgers that we're going to be using. So in January, we know that we're going to be using accrued income. So our first ledger is going to be accrued income, and we are going to be recognizing the revenue. So we know that we want to be putting it into our revenue. As we're doing the January management accounts, we need to recognise the £1,000 in our revenue. So we recognise the £1,000 as a credit in our revenue. And the debit, instead of it being accounts receivable, because we haven't raised the bill, it hits our accrued income ledger. So that's our January. Now moving to February, we know that we've brought forward an accrued income balance here. We will be using revenue and also our accounts receivable. So we're going to do our accrued income, which currently has a brought forward balance of £1,000. We're going to be doing the raising of our invoice. So the double entry for this is credit revenue, 1k, and debit accounts receivable. Now, if you notice, we've got £1,000 already recognised in January, so we can't recognise the same income again in February here. So what we need to do is we need to now reverse out our accrued income. We debit our revenue to get rid of the £1,000 sitting in our revenue ledger. So this is now 0, because 1k debit and 1k credit is nets to 0. We then credit our accrued income for 1k, and that's our double entry. And now our accrued income ledger balance is 0, our revenue is 0, and we've got a 1k invoice outstanding here, and we recognise revenue in January, which is the correct month because that's when our management accounts relates to. I hope that makes sense. If you've watched my accruals and prepayments video, you should now see some sort of pattern here. The deferred income and accrued income is essentially the same as accruals and prepayments, but just for income rather than expenses. Deferred income moves revenue out of the P&L from the current period, and accrued income brings it into the P&L for the current period. If you enjoyed the video, please give it a like and subscribe, and if you have any questions, just leave them in the comments down below and I'll be sure to get back to you, and I will see you on the next one.